Hi, we are the team number one, and in this video we are going to talk about how accounting helps the companies and why it's important to them.
Hello, my name is Octavio Sanchez. I'm going to talk to you about the importance of decision making in the accounting of company. Financial performance evolution. Accounting provides key information about a company's financial health, such as income, expenses, assets, and abilities. This information helps managers assess the current and past performance of the company, identify trends, and project future performance. Identification of improvement areas. By analyzing financial statements and other accounting reports, managers can identify areas where the company is struggling or not efficiently utilizing its resources. This may include cost reduction, improving operational efficiency, or diversifying revenue sources. Efficient resource allocation. Accounting provides information on how the company resources, such as capital, labor, and assets, are being used. With this information, managers can make decisions on how to allocate resources more efficiently to maximize benefits and minimize costs. Legal and tax compliance. Accounting ensures that the company complies with financial and tax laws and regulations. This includes timely filing of financial reports, compliance with accounting standards, and accurate and complete tax filings. Strategic planning. Accounting information helps managers develop and adjust business strategy. By better understanding that company financial situation, they can make more informed. In conclusion, decision-making in accounting is essential for effective company management, as it provides the necessary information to evaluate performance, identify opportunities and risk, and take action to ensure long-term success. Thank you.
I'm gonna talk about accounting helping ensure legal compliance in the company. Accounting helps the company recording and tracking transactions, accounts records, and documental of financial transactions of the company, ensuring compliance with legal reporting and recording requirements. It also helps the preparation of financial statements. Accounts prepare financial statements that must comply with recurrent legal and accounting regulations. This financial statement produce correction information for meeting reporting requirements to regulatory entities and tax authorities. The accounting also helps tax accompliance manage the preparation and filings of the company tax returns, ensuring that all the tax obligations established the law are met. This includes accurately calculating taxes owed and timely filing returns with the tax authorities. It helps also comply with accounting regulations. Company must adhere to certain accounting regulations established by regulatory bodies. Accounts ensure that the company complies with these regulations, such as generally accepted accounting principles (GAAP) or the International Financial Reporting Standards (IFRS) as impeccable. The accounting also helps with the internal and external audits. Accounts may account internal audits to ensure that company financial products are in company with the laws and regulations. Additionally, they collab with external auditors during external audits to demonstrate that the company complies with applicable legal and accounting standards.
Financial planning. When a company seeks external financing, whether through bank loans or investors, Account becomes a critical factor. Lenders and investors want to understand the company's financial condition and ability to repay. Accounting reports allow these parties to assess risk and make informed decisions about granting funds. Financial statements allow you to compare the company's performance over time and a comparison with other companies in the same sector. This helps identify trends, evaluate effectiveness and efficiency, and adjust strategies based on past and current results. Accounting provides information about the direct and the indirect costs associated with the production and distribution of goods and services. This information is essential to establish prices that cover costs and generate profits while being competitive in the market. Accounting is essential for planning budgets are based on accounting historical and project data, helping business define realistic financial goals, allocate resources efficiently, and measure progress toward financial goals over time. Accounting allows you to analyze the profitability of various aspects of the business, such as individual products, product lines, or division, by understanding which parts of the business are most profitable and which might need adjustment. Leaders can make information decisions about how to allocate resources and which areas to focus on to maximize profits. By having all obligations clear and written down in an orderly manner, you will prevent any debt from going past the deadline. Thus, avoiding interest payments or late penalties, accounting helps in making takes from having clear accounts to allowing access to financing from banks and useful in all types of companies, whether small business or large corporation.
Performance appraisals are a key tool for managing and developing your accounting staff. They can help you identify strengths, weaknesses, opportunities, and challenges for each employee, as well as align their objectives with the organization's strategy. However, to maximize the value of performance appraisals, you should follow some best practices before, during, and after the process. This is a process that involves the financial study by means of different indicators that allows to know the resources of an organization are managed to determine its economic situation in order for companies to enjoy healthy finances. They need to frequently review and analyze sales, profit margins, and cash flow, among other financial indicators. With this, it's possible to quickly change the course of business and correct strategies, responding to the various financial ratios that each business has, and to study precisely how a company's financial performance is. It refers to the way in which the financial indicators are assumed, which reflect the fulfillment of the economic objectives of an organization, taking into account the growth of profits with the return of investments and sales. In this sense, the financial performance of a company can vary between full potential and low performance. Performance accounting takes the ideas or objectives of the organization and determines how best to increase the output of each idea or objective to maximize the economic wealth of the company. Goldratt's theory of constraints management method is a fundamental component to performance accounting. The theory of constraints management method is based on 5 different steps. The first step is to identify the constraint that limits the firm's goal or objective. The second step is for managers to decide how best to avoid the constraint and limit the waste of company resources on the constraint. The third and fourth step involves dropping the minor business constraints and putting the major constraints first by improving business methods. The fifth step should be the result of eliminating the major constraint form of the production process. If the constraint still exists, the company may need to start over in the theory of constraint process. In conclusion, accounting is essential to a company because it provides crucial financial information for decision making, enables compliance with tax and legal obligations, facilitates financial planning, and cost control, and provides transparency and credibility to investors and other stakeholders. In short, it is fundamental to the efficient management and long-term success of any business.
Transparency in accountability. Maintaining transparent and accurate accounting record promotes trust among owners, inventors, lenders, and other stakeholders. It facilitates accountability by providing a clear and detailed picture of the company's financial situation. In summary, accounting is essential in a company because it provides valuable information for financial management, legal and tax compliance, strategic planning, and accountability. Without proper accounting, it will be difficult for a company to operate efficiently, make informed decisions, or maintain the trust of its stakeholders.